My name is Dan Dorval, and I'm President and CEO of Dorval and Cherney Financial Advisors. I am an independent certified financial planner and author of my book, Financial Success for the Rest of Us, Reality-Based Financial Planning for Mainstream America.
Hi, my name is Leah Woodley. I'm an associate financial advisor with Dorval and Cherney Financial Advisors. Our conversations discuss what it means to do quality of life planning in all areas of your life.
Dan, sometimes as a benefit, employers offer stock to their employees within their 401k. Now, for employees that work for a significant amount of time for the employer, this can come up to be a great sum of assets. So, with that, there is a planning opportunity under net unrealized appreciation. Why don't you talk about that?
So, net unrealized appreciation, or NUA, is a strategy that a lot of people will see, like out in the social media world. They might have heard about it. It's a technique that is a little bit confusing for a lot of people. Basically, what happens is when you separate service, so this is not while you're working for them, but when you separate service, if you are considering a rollover of your 401k plan or employer sponsored retirement plan over to an IRA, you have to be aware that there are some potential options that could impact your taxation. And so a conventional 401k rollover just basically sells everything over here. You move it over to an IRA. There are no tax ramifications. But now all of the money in that IRA, assuming it's pre-tax rather than Roth, all of that money in that IRA will be taxable as income or ordinary income when you withdraw that money. However, if a portion of my 401k was employer stock, and if I happen to have very low cost basis in that stock, meaning I paid very little for that stock and now maybe it's worth a lot, I have the opportunity to roll that stock out, move it from that pre-tax retirement account into a regular brokerage account. I am then taxed as ordinary income on just that little cost basis amount, not the full value, but just that little cost basis amount. And then now, if I decide to sell that stock at some point, those gains are taxed as long-term capital gains. If I die with that stock, I might even be able to get step up in cost basis, and I may not pay any income tax on those long-term capital gains. So this is a very important, basically a tactic or a strategy that you can use to potentially reduce your taxes.
So, would you say that this tactic is applicable for everyone? Anyone who has employer stock use this? Or
Yeah, this is the classic example of financial planning where just because you can do something doesn't mean you should do something. This goes along with Roth conversions and other things that people do just to change their tax situation. And so for many people that we see, they didn't necessarily work for some high flying tech company. They might have worked for a company that just had like steady growth over a long period of time. And their cost basis might be this big, and their gains are maybe just a little bit bigger, not that much bigger. And so, from that perspective, your potential benefit from really kind of changing this whole strategy, your potential benefit is minimized. And in that case, you might decide, hey, I'm just going to sell the stock to a rollover to an IRA, and everything will be taxed as ordinary income. Because if I have $100,000 worth of cost basis, but my stock is worth 150,000. Well, when I roll it out to the brokerage, I got to pay income tax on $100,000 right then and there. And that might be a very high tax rate. Now, if it's 100,000 and the gains are 1 million, okay, now we've got a whole different scenario. I'll gladly pay ordinary income tax in many cases on my cost basis or the $100,000 in order for the $1 million of gains to get a potential tax preference.
so, with that being said, who would be the ideal client to utilize the NUA?
Yeah, the ideal client is somebody who worked for a rapidly growing company where their
Mhm.
stock has appreciated greatly during the time that they've been there. So a lot of times this might be somebody who started with a company when they were, the company was much smaller. Now they've grown into a very large company and their cost basis on their shares, as I said, is relatively modest and the gains are significant. So you'll see this commonly with tech companies. If somebody has worked for Amazon for a really, really long time, or maybe Google or Apple, they very likely have stock and they probably have a low cost basis relative to their overall gains. For a lot of people, though, what'll happen is they have a relatively small stock position to begin with. The cost basis, even if they've had a lot of gains, if the overall amount is small relative to their overall 401k, probably isn't worth the headache of going through the NUA process because now you've got to track all this stuff. You have to make sure you did it all correctly in the first place. You have to report
Mhm.
it correctly on your taxes. And so there are a lot of places here for somebody to make a mistake.
So, with that being said, is there any situations in which someone can lose that NUA opportunity?
Yeah, so if I just do my rollover and I didn't know that the NUA opportunity existed at all, well,
Hmm.
now it's gone.
Yeah.
And I will tell you from experience that if somebody has company stock, the custodians that we commonly see, so this might be like a Fidelity or a Vanguard or one of the large custodians, in many cases they will remind the person right on the phone, like before they do a rollover, they'll say, "Hey, you have company stock, you have a
Hmm.
potential for an NUA opportunity." Now, this
Hmm.
ends up just confusing the person because it's not like the person on the line gives them any advice. They just say, "Hey, you have the opportunity to do this." And in some cases, the person doesn't understand what that means. They just do the rollover. And
Hmm.
now I've lost all of that opportunity to do that. In other cases, they go, "Oh, well, this must be something that's really good for me," when in reality, maybe it doesn't apply to them. It's not an important benefit for them. So NUA is one of those things that we hear about a lot because advisors can add value through the NUA process. But at the same time, it is not applicable for everybody that has company stock.
Got it. So, as an advisor, when you're looking at this, what considerations are you making in terms of fitting this into, the overall planning strategy for a client, their overall puzzle?
Well, one of the biggest things is if somebody has so much money in their retirement accounts that they can roll this company stock out with substantial gains, pay income tax on a small amount of money or a relatively small amount of money, and then allow those gains to basically stay in there. Now I have two planning opportunities. One is I could ultimately keep it for legacy and just when I pass away, my heirs will get a step up in cost basis and not I didn't pay tax on any of those gains at all, and my heirs don't pay tax either. Number two is I could, if I'm charitably inclined, I could gift away to charity some of those appreciated shares. I get a write-off for the entire amount, but I never had to, recognize any of those capital gains. And when the charity sells the stock directly, they don't recognize any capital gains either because they're a tax preference entity. So there are planning opportunities here, but it's usually the biggest opportunities are when somebody won't need that portion of their money. If they need the money, one of the big things that can happen here is if they have no like Roth or non-qualified type assets and everything's just sitting in pre-tax, by getting it out into the brokerage account, paying tax on at least the income side of it, may now create this non-qualified asset where if they sell the capital gains, if they're in the 12% tax bracket, long-term capital gains are taxed 0% for federal
Mhm.
taxes. You might be able to systematically sell some of those shares over time and also gain the tax advantage that way. So there are definitely planning opportunities here for somebody that's aware of NUA.
Well, thank you so much for all the information you shared about NUA. Is there anything else you would like to add?
Well, like I said, this is a strategy we see all the time on the internet or social media. and there's a lot of confusion. So talking to an advisor, this is one of those things where making sure they understand what NUA is, but more importantly, how do you apply it in all those puzzle pieces of maybe a retirement plan or other goals that you might have. It's critically important to have an advisor in this situation.
Yeah, definitely not a DIY situation. Well, thank you so much. And until next time, have a great one.
Thanks, Leah.